why grocery bills are becoming outrageous, and something that once cost $9.99 now costs $14.99 in the matter of 24 months, and it's absolutely insane. Now, there's no doubt that inflation is here. It was reported to be at 4.7%. And when inflation goes up, interest rates are to follow. Now, we all knew that interest rates were set to rise next year, but there's been much chatter around raising them sooner than later. And the real question is, how often are they set to increase? Now, in this video, we're going to be talking about the Canadian interest rates and what they could do in the next year and how could they impact you. But before we dive in, please take a moment to hit subscribe, ring that bell, and hit the like button. It would really help get this page in front of more people who want to see this type of content, and I would truly appreciate it. If you're new here, my name is Alice Prince, broker with Royal LePage Signature, team lead for Prince & Co., specializing working in York Region, Durham Region, and Toronto real estate. If you're interested in chatting more, you can actually book an appointment directly with me. Just go in the description below and book a buyer consultation, seller consultation, or just a time to chat more about real estate. Alrighty, so we've heard it. Interest rates are set to rise. There's no doubt about that. We've had a period for almost 2 years where Canada printed so much money, and every time I go to the store, I can't believe how much more items are costing now. Prices are surging on almost everything, and during these times of great extreme inflation, owning assets, whether that's a property or stocks, can actually build you more wealth because those assets typically go up and they're actually a hedge against inflation. Just before the pandemic hit, the overnight lending rate was 1.75%, and we're currently at 0.25%. So that's a massive drop since March 2020, and we're going to have to build our way back up to see a healthier economic environment. Now, there has been many articles written by many different economists speculating about how many times interest rates will go up over the next year and the impact that it's going to have, particularly on the housing sector. And so with that comes a large portion of the population in the comments section spewing hate on real estate, wishing for this crash, and really forecasting this bubble to burst into flames and go absolutely bananas. Now, I'm not an economist and I don't pretend to be, but let's talk about this for a second. The best economists don't know for sure what's going to be happening or what's in store for the future, because no one really does. And I can go down a rabbit hole about the fundamentals of the market and what drives real estate prices. But what I've been saying for a while now is the only thing that's going to really slow down real estate prices is if they magically bring more supply to the marketplace that is in line with our population growth. That, and if interest rates go to the moon in a short period of time, which in my opinion, I don't really see that happening because real estate actually accounts for a pretty good portion of the Canadian gross domestic product. And to give you an idea, the seasonally adjusted annual rate of investment hit $249.3 billion in Q2 of 2021. So if they had skyrocketed the interest rates in a short period of time, then we would actually kind of be in really big trouble. But let's stick to the interest rates for now for the sake of this video, not getting too long, and really unpack what that could mean for you. Now, if you're a buyer and have been feeling a little bit frustrated with where these home prices are going, or sitting on the sidelines thinking that rising interest rates will decrease home values, you may be onto something here, but there's so much more other factors to consider. Now, what's important to remember is that when you're purchasing a property, you're not just purchasing a purchase price, you're purchasing that monthly payment. And when interest rates go up, money costs more to borrow. So even if prices slightly drop, the carrying cost of that property is likely going to be the same, if not more in some instances. The market absolutely needs to cool down, there's no doubt about that, because what's happening specifically out in the suburbs just is not sustainable. But if the overnight lending rate gets to even 0.75% or even hits 1%, that doesn't guarantee that prices will drop, just the acceleration of appreciation. So meaning how fast that they're moving in that upward trajectory, it's going to likely stall or level out. By the Business Insider that stated, now get ready for a 90% collapse in Canadian real estate prices. There was an interview done with Nicole Foss on why the real estate bubble will burst and could take out 90% in homes value. But let's just go back to the historical data and see what happened in 2010. This was the end of the year. So home prices in Toronto real estate
in the GTA were 431,000. In 2011, they went up to 464,000. In 2012, they went up to 497,000. So we actually did not see any 90% drop in homes value. Earlier that year, it was written. A report was written by CBC, February 10th, 2010. Should Canadians fear a housing bubble trouble? And you can see in this report that the MLS data shows that an average resale home in Canada sold for $337,410 in December, which was up 19% from a year earlier. Sales were up a stunning 72%. This is similar to now. Prices are rising double digits and sales are up significantly. So again, just back to the historical data of what happened here. So prices did rise. Now, in 2011, another article came out written by CBC, predicting that the housing bubble is set to burst and prices could plunge as much as 25%. It said here that the housing evaluations have lost touch with all fundamentals and housing debt is at a record high, which was written by an economist as a research consultancy of capital economics. But let's go back to what happened in 2011. 464,000, 497,000, 522,000. So you can see that prices are going up year over year. Then there was an article written by Maclean's and it read, "The Great Canadian Real Estate Crash of 2013. The housing bubble has burst and a few will emerge unscathed." Let's look at what happened in 2013. 522 was the average price. Then it rose to 566. Then it rose again to 622. Then it rose again to 729. And this was kind of when the hype started coming down the pipeline for 2016, 2017, and then the government had to step in. Now, this article here was written in 2017, just after the 16 4-point housing plan was implemented. And it read, "The frenzy is over, Toronto's housing bubble finally pops." And so in 2017, as I mentioned, we did see a correction in particular markets such as York and Peel region after that foreign buyer tax was implemented, along with the 16 4-point housing plan. Now, whenever there is a policy change, there is a psychological change in people and they put on their brakes. But even if you bought at the hype of this market in 2016 when things were very, very frothy and you held on to your property for 4, 5, 6 years later, to date, you're still going to come out on top. The point I'm trying to make here is that real estate needs to be looked at as a long-term investment. The market will always ebb and flow, but what we've seen is an upward long-term trajectory. So don't try and time the market according to reading these articles online, because it's likely that you're going to lose every time.
But these things don't move in a strictly linear fashion, so there will be periods of fast rising prices, periods of slow rising prices, stable periods, and even down periods, just like we experienced for the first couple of months of COVID for houses, or the fall of 2020 for condos, or the late spring and summer of 2017 for houses after the Ontario 16 Fair-Point housing plan was announced. Now, we could see a correction as interest rates start to rise and people make different buying decisions for sure, but I don't know how big of a correction people are really rooting for or realistically even expecting. But what I've done is I've looked at 7 correction scenarios to see just how far back in time that prices, if they were to go back, where would we be at? Now, the average price of a detached home in Toronto for the month of October 2021 was just over $1.7 million. However, for this analysis, I'm actually going to stick to using the home price index, which tracks what a benchmark price is for a single family detached home. The reason that I do that is because average prices are really subject to a lot more fluctuation, really depending on the underlying mix of the houses sold. So HPI really strips out those outliers. And as you can see here, the single family detached benchmark for October was a little bit lower, coming in at just over 1.6 million. Now, what I'm trying to answer here is if we had a 10%, 20%, 30% or more pullback in the market, how far back would that set us? Now, due to the high real estate appreciation and prices, the answer is not very far. A 10% correction really only takes us back to as far as April. And I'm sure that people that are up in arms about the prices now and hoping for a big price drop were also hoping for one 6 months ago. So to sum up this video, interest rates are going to rise. If you're a buyer right now and haven't talked to your mortgage broker, I strongly suggest that you start speaking to them to lock in a mortgage rate. Now, one thing that should really give you peace of mind is that in 2018, Canada implemented something that you're all familiar with called a stress test on mortgages. So the average consumer could afford 2 basis points higher in terms of what their interest rate was versus what they were qualified for. So they're going to be okay. Now, getting into the market will be a little bit more challenging next year. Even though the demand might not be as crazy, we still really do have a supply issue. So I think that as we move into 2022, with the interest rates going a little bit higher, prices won't be as crazy as they are now this year in terms of growth, but I don't think that they're necessarily going to fall off the cliff. Now, any large correction or crash was obviously going to be helpful to that prospective Toronto buyer, but it's not going to transport them back in time as far as they'd like or would probably want to go. So there you have it. If you have any questions or need a great referral to a mortgage broker, please never hesitate to get in touch. I am always here for you. Ciao for now, and we'll catch you on the next one.